in the next few months, everything will be monetary policy. And this is what we're seeing right now. Right now, everybody is bullish because they perceive that the Fed is going to U-turn on its rate hike path. And that may change very rapidly just with a CPI print. So let's not count our blessings with inflation when inflation remains so elevated. The macro environment remains poor. But more importantly, I think that it's extremely dangerous to think that all the worst has passed when core inflation continues to rise in the developed economies and the level of headline inflation remains elevated despite the U-turn on and the basic change in prices of commodities. So if everything is going to be about monetary policy, the best thing to do with a portfolio is to be prudent, not to buy risk on any hint of a small decrease in headline inflation. One of the things that we have seen in 2022 is that a lot of countries said that they were very happy because debt to GDP was slightly lower because of the recovery in GDP. However, if we look at what is really going on, global debt again will be a record high in 2023. And more importantly, it is quite likely that in 2023, the improvement in terms of the relative ratio of debt to GDP is likely to be very, very poor. Debt to GDP, public debt to GDP, is not a good measure. Why? For a very simple reason. Public debt to GDP. If GDP is inflated with higher government spending, which is financed with debt, you're basically comparing the increase in debt with an increase in GDP that is inflated by that debt itself. So it shows a lower level than what we should be concerned with if we looked at the fundamentals. So what fundamentals do we need to look at? The ability to pay higher interest on that debt. Many countries are already deficit spending. Interest expenses are going to go up. And that deficit is likely either to rise or to remain elevated. Therefore, that is a clear signal of stress.
I have to say that I've never seen a more desperate Wall Street looking for weakness early, trying to get the Fed to turn on a dime. We don't think that's going to happen necessarily. We're looking for really a situation where the rates will stay up for some time, probably longer than most people expect, at least into the first and second quarter. They will also have lower earnings. Our big key for this year is this. 2022 was a bear market because you had interest rates blow everybody up. We think 2023, at least in the first 2 or 3 quarters, will be more of a bear market because you'll have an earnings recession, which will cause a problem with overall recessionary problems. So when we see that, what we're looking for is a continued weakness on the earnings side, which will probably show up now in the price earnings, which will then show up in the price of these stocks. So that's how we've been situated. That's how we are situated. We had a lot of liquidity in 2022. We still have that same amount of liquidity. We do have about a 5 to 6% position in gold and gold miners and a couple of strategies. But we own a lot of treasuries that are paying 4.5% or better short term. So we're really not giving up a lot to wait on that. And our expectations are that it's going to get tougher and tougher for people that have been used to the last 12 years just plugging in and letting the market make them a lot of money. We think it's going to be one of those where you're going to have to know this year, know a little bit about what you're doing, which means at times you're going to have more liquidity than other times. But it also sets up to where you can really have some great opportunity this year. It's not necessarily a negative because you see that on the horizon, and we get our best buys and our best returns we've had as a firm have always come off of big market lows. And so we wouldn't be surprised to see the weakness go on into 23. We'll have to see how it goes. And as always, if we've got it wrong, and we've had it wrong before, if we have it wrong, we'll make an adjustment. But all the best to you this year, Daniel. Happy New Year to you and all the followers. You have a great site, and always enjoy what you have to say. Thanks a lot.
Cryptocurrencies are bouncing, but unfortunately, they're not bouncing because of their underlying strength, but because of a generalized risk-on appetite. When cryptocurrencies rise because European stocks and bonds and the general risky asset environment rises, then it doesn't tell us a lot. It doesn't say anything about what is going to happen in the few months that we still have ahead of us before we get the impression of what is going to happen, if there's going to be another bankruptcy in one of these exchanges or if there's going to be further problems. So I don't think that there's going to be a relatively easy environment for cryptocurrencies in 2023. Unfortunately, cryptocurrencies have shown their Achilles heel, and their Achilles heel is that they need more dollar liquidity in order to continue to increase in price, that they are not working as the decorrelated asset that, for example, gold is. Gold is showing its strength as a reserve of value, as a unit of measure, and as real money. Cryptocurrencies continue to be startup currencies, and we have to differentiate between cryptocurrencies as possible at one point different alternatives to fiat currencies. They're not yet, they're startup currencies, and risky assets in which to invest expecting an increase in price. Right now, it's in no man's land, and it depends entirely on whether monetary policy from central banks is accommodative or restrictive. And with restrictive monetary policy, cryptocurrencies will likely suffer in the midterm. We are starting to see a very relevant dollar weakness, and dollar weakness is usually perceived as a sign of risk on. However, that dollar weakness might not last for long, for a very simple reason. Global demand for US dollars has been rising consistently every year as emerging economies and other global entities have increased their issuance of debt in US dollars. And at the same time, the level of confidence in emerging economy currencies has declined. Therefore, the demand for dollars is likely to continue to increase, while the current perception of risk-on environment is basically just a huge carry trade against the US dollar. So we need to look at the global demand picture for reserve currencies, because those reserve currencies are actually diminishing. And the dollar is a bellwether for risk. Right now, certainly, risk demand is extremely elevated. We have seen that the global risk demand index is rising quite significantly, but it's also showing elevated levels of overbought territory in a number of risky assets, fundamentally in Europe and in some of the emerging economies. So let's pay attention to the US dollar. It does not look to me like the US dollar is going to weaken significantly and for a prolonged period of time, because the global currency debasement continues, and this is not a game of who wins, it's a game of who loses. United States inflation is cooling down. However, we must remember that core inflation continues to rise, and the very excessive reaction of markets, thinking that this is the end and that it comes with a change in policy from the Federal Reserve, is certainly misguided. Because let's think about this. To start with, the drop in inflation comes mostly from the energy components. However, as I said before, core inflation is rising. This means that the Federal Reserve is likely to continue with its rate hike path, and it certainly is not going to start reducing rates until the levels of core inflation start to show very, very significant declines from where they are today. We need to understand this for a very simple reason. We saw in August of 2022 a very similar reaction. Everybody started to get excited about a 7% inflation and thinking that the Fed was going to make a U-turn. The Fed has a very clear path, and it needs to follow it, because if it doesn't take care of inflation and if it doesn't act on inflation, the risk of stagflation is even larger than what it is today, and it certainly is not going to get any better in the problem that they already have, which is balance sheet losses, so central bank losses. So let's remember, central banks need to hike rates. They will probably keep those rates elevated once they reach the peak, probably in June of 2023, and they need to reduce the balance sheet. And that last part has not happened yet. So the biggest impact for markets is what is going to happen when they reduce the balance sheet, because the decrease in liquidity might be very severe. Technology stocks are not cheap, and they were not cheap anyway in 2019. So when we look at the opportunity to buy technology stocks, what we need to look at is the level of guidance, the ability to retain the strong margins that they had in 2020 and 2021, and the possibility of these stocks requiring new injections of capital. So when we look at technology giants, what I would be interested in is in companies that have already strong earnings, good margins, high levels of cash flow, and that do not require capital increases to continue functioning. More importantly, I think that those that are reducing headcount in a strong way, in a prudent way, are the ones that are likely to come out stronger than their peers. So I don't see a lot of opportunities in the NASDAQ as an index in itself, but I think that technology giants that follow those criteria would be interesting stocks to look at, particularly now that they are starting to look relatively more attractive. In the next few months, we're going to see a lot of companies providing guidance, and we need to understand whether that guidance is achievable and if the earnings profile that has been set up by consensus is prudent or continues to be excessively optimistic. We have seen massive downgrades of earnings, but it looks that many of these earnings estimates remain optimistic for 2024. So we need to think of what these companies are going to say about the outlook. We need to see whether they give hard and real data when they give guidance, and to differentiate stocks according to their ability to deliver on their earnings targets and their profile. The European economy might have escaped recession because of a mild winter and lower commodity prices, but it has not escaped stagnation, and it certainly has not escaped inflation. The levels of inflation in the Eurozone remain extremely elevated, particularly considering what has happened with commodity prices. So core inflation remains very, very high, and the European Central Bank is caught between a rock and a hard place. On the one hand, it needs to reduce the balance sheet and increase rates, and on the other hand, it faces a very significant challenge as governments all over the Eurozone do not want to reduce their deficit spending programs. Therefore, there is a huge challenge in many of the Eurozone budgets because governments don't want to enter into a period of reduction of spending and at the same time, the cost of borrowing has multiplied by 4 times in some cases. So the challenge in terms of budget and the challenge in terms of access to financing is still there. Right now, we do not see it because we're in an environment of risk-on appetite. However, this is a long game and it's a long run, and we need to see whether that will play out in a positive way. I find it difficult. I find it very, very difficult to believe that the Eurozone is going to escape some challenges in the credit front, particularly for the southern peripheral economies, because the problems of fiscal and monetary policy have been disguised for a period of time, but they have not been eliminated.